Good morning. You are watching a live daily market outlook for Tuesday, 8th of May 2012. The situation in the market sees no changes from the previous day, as the most of the instruments were in the short-term corrective mode, but overall sentiment remains so far, I would say, quite unchanged. The focus is still at two key points. The most significant events that happened during the week in Greece and France, with Greece's left coalition party now getting an historic chance on today to form a government opposed to the country's EU IMF bailout, after the mainstream conservatives failed to get together a coalition following the shock election results. The odds are stacked against it and raising the prospect of fresh elections. Greek plunged their country into political limbo on Sunday election, angry with the harsh cuts dictated by the bailout deal, which is keeping Greece afloat, but has also brought the worst unemployment and recession in decades. By sparing the two main parties, New Democracy and PASOK, voters shrugged off the risk of bankruptcy and the threat to Greece's future in the euro. Although government officials warned that cash was running out fast. If political leaders fail to form a coalition, Greece risks new elections as soon as next month, plunging the country into fresh uncertainty. Along with the recent data, disappointing actually, releases of Eurozone economic indicators and the current political uncertainty regarding Greece and France that have changed the direction of their governments towards the left side. More uncertainty is seen over the Eurozone, as a fragile recovery attempt is now seems to be running out of steam again and threatening the bloc of Euro countries entering a new phase of recession. As a direct result, the Euro plunged during the last week, hitting levels below 130. That was acting as a quite strong support zone, with the current recovery seen yesterday and the overnight still being unable to regain some important levels in order to prove and provide the base for a stronger correction. Similar with the sterling, that still holds below 162 level after bouncing off yesterday's fresh high at 161.13, while the dollar holds negative tone versus Japanese yen, as well. Brief recovery of yesterday's fresh low when the pair fully retraced the recent corrective rally that was capped at 80.60s, again capped at 80.00, and keeping the focus on the downside. From the other side, the dollar keeps its strength against Swiss franc, as last week's closing level at 91.80 zone now offers good support, as the recent corrective pullback of 92.69, yesterday's fresh high, was contained just above this level. Gold has ticked lower during the overnight session, as backlash by voters in Greece and France against austerity measures kept the pressure on euro, although the prices were supported briefly by bargain hunters lurking around the lower end of the metals recent range. But the gold is still seen as the gold price is still seen at the downside risk, with the supports at 1624 now coming into focus. The crude oil was steady after suffering heavy losses last week, that dipped as low as 95.33. That was the low of yesterday, with brief recovery so far being capped at around 98 zone. There have been also some bargain hunting with investors, but with the opinion that prices are oversold after recent heavy losses, the possibilities the markets will be pricing for a potential another long-term refinancing operation announcement in Europe, which will likely be supportive for oil markets going forward. We will see how this is going to be, as generally current deepening of the crisis from both sides of the Atlantic increase the fears of investors of possible further lowering of demand for the energies. That resulted basically in the recent sharp fall from during the last week, when the oil completely lost ground, falling from 106 pardon 40 level that was seen on the beginning of last week, dipping to 195 93 as mentioned previously on yesterday's trading. And also the important was a break below some important levels and the short-term range floors, as well as losing $100 per barrel as strong psychological support. Now we will see whether the oil prices will continue its slump, or some more uncertainty in the world economies will again become more supportive for the crude oil. From the other side, the International Monetary Fund showed some new flexibility yesterday over how quickly it would press deeply indebted countries to bring their budgets under control if economic growth weakens. Its shifted tone could prove important for Athens, where changes have jumped that the new Greek government would seek to renegotiate its 130 billion euro bailout package with IMF and the European Union after Greek voters rejected austerity measures in their weekend elections. The IMF Managing Director Christine Lagarde, in a speech in Zurich yesterday, said most advanced countries are proceeding with the fiscal consolidation at a prudent pace of about 1% of GDP a year. But also she said that the IMF is aware that fiscal austerity holds back growth and the effects are worse in an economic downturn. Hence, calibrating the cutback and achieving the right pace are essential, Lagarde said. From today's calendar, that is not very big. We're just going to take the highlights. The Swiss consumer climate is due at 8:45 GMT, slight improvement. Minus 18 is forecast for today compared to minus 19 of the previous fourth quarter of 2011, with the Australian annual budget release seen at 12:30 GMT. At I think we have a small pardon, the times are not in GMT, the times are in the local Cyprus time, so we need to correct. At 10 o'clock GMT is the German industrial production for March, that is expected to go up by 0.8% compared to the draw of previous month at minus 1.3%. At 12:15 is Canadian housing starts for April. Slight decrease compared to the previous release of March at 216,000 units is seen at 204,000 units. At 12:30 GMT, the ECB President Draghi is due to have a speech. At 1400 GMT is the U.S. economic optimism for May, that is forecasted at higher than the previous release at 49.3. Today's forecast is 50.3. We're going to take a look now at the markets and see the latest movements of the major currencies and the commodities, as always starting with the euro dollar. As we can see, the block currency has made some corrective action of yesterday's fresh low at 129.53, but gains were limited at 130.60 zone, and the last week's low and closing price at 130.80 along with 55 days exponential moving average proved to be quite a tough barrier for the single currency for now. And as long as holding below 130.80 and 131.00, the immediate risk remains at the downside, as still a negative tone persists on the 1 hour chart, with the MACD being unable to break above midline, and the quick loss of momentum sees potential of further easing. 4 hour chart maintains, studies maintain negative tone, with the latest bounce seen as just a brief correction, as descending moving averages are maintaining the last week's negative tone, and the sharp sell-off of 132.82 that ended down at 129.53, low of yesterday. Daily chart shows more interesting points, as the pair broke briefly below the main and the key medium-term support zone that is defined by 130 on the upside and 129.50 on the downside. That marks also 61.8% Fibonacci retracement of 126.22 year low of the year 2012 posted in mid-January, and 134.85 year-to-date high of 2012 posted on end of February. With the clear break below this strong support, that also marks the range of multi-month range floor to open a way for fresh leg lower, with the 129.00 and 128.75 lows of January 2012, as well as January 2011. Very significant support to come next in focus in case of clear break below 129.50. On the upside, as set, as long as 131 holds, the recovery attempts will be minimized and will not allow for a further expansion. Otherwise, break above 131 is to open the next very significant and the near-term double top pattern at 131.80, which is the basically the key barrier. As close to this, there is also 61.8% of the recent down leg from last week's peak at 132.82 down to 129.53, and only break above this level is will be turning focus higher towards 132.82 and more significant 133.00 psychological barrier. A similar situation is shown on the cable's hourly chart, as a bounce of yesterday's fresh low at 161.13. That marks also 38.2% of the retracement of the broader rally from 158.17 up to 163.00 peak of 30th of April 2012, where the temporary support was found. The recovery was so far short-lived, as the next barrier at 162 zone has so far capped the upside attempts, and the subsequent easing to 161.45, denting the initial support zone, is now increasing risk of further weakness. A quick loss of the strength on the 1 hour studies sees the risk of further easing of the pair, while 4 hour chart studies remain under their midlines, and the brief break above moving averages has resulted in extension towards to 162, where the gains were so far capped. As only clear break above 162 and 162.50 is required to refocus 163.00 and open way for a further extension higher, as the broader picture still shows the uptrend, medium-term uptrend from 13th of January, yearly low at 152.33, intact, with the latest pullback seen as corrective, as long as breakpoint at 160.80, 160.60 holds the downside, along with the 160.00, the trend line support, main trend line support drawn of 152.33. So as long as this strong support zone, I would say 161.00, and the 160.80-60 zone holds, immediate focus on the daily chart will still be at the upside, with the clear break above 163.00 to open a Fibonacci barrier at 163.88 that marks 76.4% Fibonacci retracement of the broader down move from 167.45 a high of 2011 down to 152.33 high low of 2012, and 164.00 as a round figure support. On the downside, I set a loss of 166, the last barrier, and the break point will open next Fibonacci support at 160.00, also the round figure support, Fibonacci 61.8%. The dollar yen is in the near term, rather, I would say, rather sideways mode after a recovery attempt of last week's low at 79.63 was capped at 80.60, and steady descent returned the price exactly to this level 79.63, ending the corrective action, with the current attempt higher being capped just at 80.00 as our initial resistance, being unable to break higher, with subsequent easing now towards 79.80 so far, just ahead of our initial support at 79.70 zone, keeping the near-term focus at the downside so far. As long as 80.00 and more significant 80.60 zone holds the downside, upside, pardon, we have 80.31 is the 55 days exponential moving average, and the immediate barrier at 80.00, which is a 20 days exponential moving average, and 80.60 is also the main bear trend line drawn of 84.08 peak. So as long as holding below these levels will signal the pair maintaining the broader downtrend of 84.17 yearly high, as the downside levels at 79.63 and 79.52, the post-intervention peak of October 2011, will be the immediate targets on the downside, the break of which to open 61.8% Fibonacci retracement at 79.13 and 79.00 peak of 1st of November 2011, also around figure support. Only break above 80.60 would ease the current bear pressure and avert immediate downside risk in favor of possible stronger recovery, with the next very significant barrier at 81.80 zone, where is also the 55 days moving average. This area only break above this level would be supportive, more supportive for the pair, and would be signaling creation of higher low at 79.63 zone and allow for a stronger recovery. Otherwise, likely scenario would be further extension lower in case of 80.60 zone capping the upside. And the last currency pair, dollar Swiss, remains in the positive tone, maintains the positive tone of last week's low at 90.41, as break of our key short-term barrier at 92.50. That also marks the short-term range top, has resulted in a brief extension above this level. 92.69 high was seen so far. This was yesterday on opening. That was followed by corrective pullback closing price of last week at 91.80 zone, where is also 20 days exponential moving average is so far offering good support, as the dips were contained just above this at 91.93 and just below our initial support at 92.00, with subsequent bounce now looking for a possible extension higher. Regain of momentum on the hourly chart, and the tone turning positive, sees potential for further extension higher, as 55 days moving average is holding the downside for now, with break above 92.50 and 92.69 required to open our next significant barrier at 93.00 and a more significant 93.30 peak of 15th of March, also 61.8% Fibonacci retracement of the down move from a yearly peak at 95.93 that bottomed at 89.30 end of February yearly low. A break here would be signaling a further expansion, further extension higher, and turn the focus towards upside levels and the peaks of the year at 95.93 and the 96.00 zone. On the downside, immediate support, as said, 91.90, is so far holding, while loss of these levels would weaken the immediate structure and the open way towards open way for a deeper reversal. 91.55 comes as 50% retracement, and 91.28, 61.8%, while loss of 91.13 higher platform would be bearish and turn focus towards 90.40 and possible extension towards 90.00, our next very significant support. And quick look at crude oil, that is in the near-term recovery mode, but against so far being limited at 98 zone. 98.17 was a fresh high seen yesterday after the price bounced off 95.33 low posted in early hours of yesterday's trading, following the sharp decline from last week's peak at 106.41 1st of May high. That accelerated basically on the negative releases during the week, and the major push was given by a weak jobs data released in America on last Friday, when the oil price lost ground and broke below 100.67, and 100 psychological support dipping so far to 195.33. As said, the recovery attempt managed only to retrace around 23.6% of the entire move from 106.40 down to 95.33, with the still weak studies on the near-term charts. Hourlies are again losing momentum, while quite negative and quite stretched studies on 4-hour chart are seeing potential for reversal, stronger correction. So far, no clear signal of further bounce higher, as the recovery got exhausted, as said, at 98 zone. I would say regain of 99.50, where is 20 days moving average, and 100 level as a psychological barrier would possibly allow for a stronger recovery. Until then, the negative tone keeps the downside more in focus, as the oil price briefly dipped below 200 days moving average on its recent medium-term decline of yearly high at 110.53 posted on 1st of March. That reversed a very quite big part of the rally from 2011 higher low at 92.70 posted on 16th of December, retracing nearly 80% of the current move, with loss of the next support at 95.33, seeing potential of further weakness. As mentioned in our introduction, possibility of further bailout in Europe may give some boost to the oil prices, but time will show whether this is going to be productive for oil, or the further slump on fears of investors of a possible reduction of demand for the energies would push the oil price even lower. That was all for today, Tuesday. We're back tomorrow morning at the same time at 7:00 GMT. All those that connected later and missed any part of the session can find the recorded version in the YouTube. Windsor Brokers page is called Windsor Brokers Forex, and this session will be shortly uploaded there. I wish you a nice day and very successful trading. Good luck.